Welcome into another market takes on what a report, what a morning. We are diving into all of this. CPI, we are breaking down the consumer price index report for May. That came in a sizzling, scalding, smoking hot 8.6% year over year. I'm going to break down what that means, why it's important, and there's a lot to unpack. So we're going to dive right into it. This is a special edition. We are looking and talking just about today's CPI Consumer Price Index report. Came out 8:30. We've had about half an hour to digest it. Markets have had about half an hour to digest it, and digest they have. We are seeing big moves, especially in the Treasury US bond market. So we're going to talk through all of that, what it means, what we saw. We're going to dig into the report, unpack all the details for you, and do all of that, man. Thank you for tuning in. I am Dion Rabouin, reporter with the Wall Street Journal. Appreciate you guys being with me. I know you could have been anywhere in the world. Instead, you're here with me, so I appreciate that. Look, let's jump right into it. 8.6% year over year for the CPI. That means inflation is rising faster in May than it was in March. March was when the Fed, lots of economists said, okay, we hit this 8.5% mark. We've peaked. We're going to be moving down from here. Inflation should, start to slowly move down towards our 2% target. No, throw all that out the window. Inflation came down a little bit in April, 8.3%, and then right back up to 8.6%, higher than the previous peak last month. We are now back to the highest since December 1981. If you tuned in on Monday, I talked about how historically we're on this move downward if we follow the same trend as the last time inflation was this high, back in the 1980s. Inflation peaked at 15% and then it moved down. And once we hit 1982, which April's reading was the highest since 1982, we continued to move down until we got to about 2.5% by 1983. And that was end of summer towards the autumn of 1983. We also had a recession in there. You had the Fed raising rates to 19% to get inflation down. The Fed right now still only at less than 1%. Interest rates are still less than 1%. Between 0.75 and 1%. We're going to have to, I think, the Fed's going to have to get on its horse and make some moves here. So look, let's get into it. Inflation did not peak in March. That's the big takeaway. The Fed retired the word transitory. Remember, all of 2021 or most of 2021, they were saying inflation will be transitory. And then in November, they said we're going to retire that word transitory and really just focus on doing our business. Jerome Powell now has some splaining to do. He's going to have to talk through, okay, not only was inflation not transitory, it continued to rise higher and higher, but it looks like it hasn't peaked, and it looks like we could be going back up. One big thing about the expectations, I have been talking to you guys about the expectations for CPI, the Consumer Price Index, for a couple weeks now. And again, expectations started around 7.2%. There were expectations for inflation to fall by about 1%, a little more than 1%. Then as we got closer and closer, as more economists reported their predictions, as more data came in, and as we know, gas prices continue to rise, food prices continue to rise, all those things, you saw more economists start to raise those predictions until today. Before the CPI report, they had gone from 7.2 to 8.1 to 8.2 to today. The expectations were for 8.3, as high as April in May, and then we got, boom, even higher than that. So we're going to talk through the long-term implications of this report. The one word I have to say is wow. Wow. Inflation a lot higher than economists were predicting. So, like I said, CPI highest since December 1981. Want to read you something from the Bureau of Labor Statistics. They put out this CPI report. It's the government agency responsible for all that. They say there was an across-the-board increase, a quote, across-the-board increase. The increase was broad-based, with the indexes for shelter, gasoline, and food being the largest contributors. Again, that tells you everything. Inflation is everywhere. It's not going away. It's not being reduced to just a few items. It's not just food and gas anymore. The energy index, though, up 34.6% year over year. That's the largest 12-month increase since the period ending September 2005. The food index up 10.1% for the year. The first increase of 10% or more since March 1981. That means that the food index is in the price of food. That's food generally you eat outdoor, prepared food. Sorry, you eat outside the home, prepared food, things like that. Hadn't ever gone up this high during this inflationary cycle that we're seeing right now. So March, when CPI peaked, food inflation still wasn't 10%. It is up over 10% now, the highest since March 1981. We did see a decline a little bit in car prices. That's good. So something to look out for there. If you look at the housing index, or the component of housing, what people at the Bureau of Labor Statistics call shelter, the index for all items less food and energy, that's the core index. We're going to get into that in just a sec, but the shelter index increased 0.6%. That's the largest monthly increase since March of 2004. So again, the cost of shelter, whether you're renting, owning, getting shelter somehow, some way, up by the highest amount since March 2004. That means higher than we've seen in previous months when inflation peaked. Again, the shelter reading was even higher than that. So we're seeing prices for food, prices for shelter, aka rent and your house, your home payment, rising by even faster paces than they were. We're seeing an acceleration. And again, 1% increase in those prices for month over month CPI. So the CPI rising at 1% from the previous month, when again, we were supposed to see this general cooling trend. So want to talk about core inflation, because the Fed, when they're doing their thing, and remember, everything right now is all about the Fed, the Federal Reserve, and what they're going to do. They like to look at those core numbers, right? They like to say, okay, energy, food, yeah. Those can jump around a lot, but what's the core doing? Well, core inflation was up by 0.6% in May. That's a significant increase. And again, that's well above expectations. Month over month, the overall CPI increased by 1%. The core CPI increased by 6%. That's ahead of expectations. Expectations were for 5.9%. So just a little bit above, but above again. And that's important because the trajectory of core inflation is supposed to be cooling down. The Fed can't say, oh, this is all just because of volatile food, volatile energy, those things will come back. No, housing, what you buy at the store, what you're paying when you get in retail goods, all of those things, those prices are staying elevated as well and coming in higher than economists expected. Now, we did come down a little bit on that core index from April. April was 6.2%. We were at 6% this month. So a little bit of some good news there, if you want to look at it that way, but certainly a lot to think about for the Federal Reserve. And remember, we will be here. I hope you'll be with me right after the Fed meeting, 4:00 p.m. on Wednesday. We'll be breaking down everything Fed Chair Jerome Powell said. We'll be talking about the decision. We'll be talking about the market reaction. Speaking of the market reaction, let's take a look, WSJ.com, what we're seeing from the markets. The 2-year yield rose up above 2.9%. That's a big, huge, massive jump. If you're looking at the price chart, it's just whoop, jumping up like that. The 10-year yield staying pretty calm, still right around 3.05%. But we did see the stock market tumble. Right now, we're seeing the Dow down by close to 1.5%. The S&P 500 also down a little more than 1.5%, and the Nasdaq. And again, these are those futures prices. So once the market opens, that could break even lower or maybe come back a little bit. But those futures on the Nasdaq down almost 2%, closing in on that negative 2% level. So let's take a step back. Let's talk a little bit about expectations. I told you how expectations had been rising consistently, again, at the beginning of the live stream today, and thank you guys again for tuning in, those of you who are out there, that expectations for CPI started about 7.2%. That would mean that inflation had cooled down there in April and had taken a significant leg down in May. We did not see that, but also before this report was released, economists were revising that higher. So the trend is not our friend right now. If you're looking for prices to start coming down or at least level off at a reasonable pace, we are not there. This is higher than the recently revised expectations, much higher. Again, we are at 8.6%. That's significant. Long-term inflation expectations, that's the big question here. How much does this report change the long-term inflation expectations? If you've tuned in here on Market Takes, I've been talking about how around the end of May, right about that May 20th time, you saw market expectations for inflation start to really meaningfully fall. And you saw longs on the 10-year break-even rate, 5-year forward rate. Basically what those mean is what the market predicts based on what people are buying and what they're selling. So the 10-year break-even rate, that just breaks out what investors are getting paid for those bonds versus what they're getting paid for inflation protection. And the higher it goes, it means the more expectations there are for higher inflation. So that 10-year break-even rate had dipped down to about 2.55% in late May. It had been ticking back up. We still weren't to the levels that we had gotten to earlier in the year and around that April time when folks were really expecting inflation to just break out and go through the roof long term. Do we start moving back there? Do we move to new highs for long-term inflation expectations? And does that mean that the Fed starts to lose credibility with investors? The biggest takeaway I think you could come away with from this report is clearly the market had believed the Fed had said, okay, the Fed's going to get inflation reined in, it's going to come down, we peaked in March. And there were also some worries, growing worries about inflation. Do we start to go back there where now folks are saying, wow, the Fed doesn't have this thing under control. We've really got to be worried about longer term inflation staying at these high levels for quite some time. And what does that mean? Fed rate hike expectations had also started to diminish. You saw the market predicting the Fed was going to raise rates to 2.5% or so in late May. Now they're predicting after this number came out this morning on CPI, Fed's going to do about 2.75%. Now there is over a 50% chance the Fed raises rates to 3%, according to Fed Fund Futures Markets, if you look at the FOMC FedWatch tool provided by CME Group. So 50%, more than a 50% chance the Fed raises rates to 3%. That's the highest that rates have been in a very long time. And this puts the chances of a 75 basis point rate hike, that's triple the pace that the Fed normally raises rates at, back on the table. If you remember, a couple of months ago, Fed Chair Jerome Powell has said 75 basis points, that's not something we're actively discussing, not something we're talking about. Maybe they have to now, because inflation is not doing what they predicted it would and what they said they expected it would. Really this disrupts the current narrative. That's the big picture. The narrative was we're going to be higher for longer, expect inflation to be higher than it normally is for a longer period of time. But we peaked in March at 8.5% and now we're coming down. This report throws off all of that. The Fed's going to have to do a lot of analysis and we're not going to hear from them because they're in their blackout period from now until Wednesday when Fed Chair Jerome Powell has his report and when the Fed releases its statement after its meeting. So the Fed is going to meet next week on Tuesday and Wednesday. We'll get that press conference on Wednesday. I hope you'll be here with us right here on Market Takes as we break down all of that and talk about the market reaction and what's going on out there everywhere in the markets. Man, the stock market not taking this well, but not as poorly as it could have been. The Dow is still hanging in there. Even the NASDAQ closing in on that negative 2% is not as bad as things could have been, given what this report means and the gravity of this report. We'll see once investors get into the office and get in those desks, once all the algos can fully go at full bore, what the market takes away from this report, but definitely a game changer for the market. And if you're a bond investor, if you're in the treasury market, things just got a lot more exciting. Like I said, that 2-year yield just spiked up over 2%. Again, we could start to see an inversion where expectations, if folks start pricing in a recession over the long term, where that 10-year yield starts to decline below that 2-year yield, and where expectations for Federal Reserve monetary policy get higher than expectations for the long-term economy, that would produce another yield curve inversion. Remember, we saw that already earlier this year. Go check out my video if you haven't yet. That's on the channel. And that could be another sign that more folks are starting to price in a recession, because we are not seeing a lot of movement this morning on that 10-year Treasury yield, which normally is a good sign. But today, I don't know, if inflation is picking back up, that could mean the Federal Reserve is going to have to hike us into a recession, or that a recession may already be priced into the market. Listen, thank you guys all for tuning in. That's going to do it for me. I am Dion Rabouin. This is my channel. I appreciate you guys tuning in here on YouTube and being with me. We are going to do this again, like I said, after the Federal Reserve's meeting on Wednesday. We will be here 4 p.m. live. I hope you all will tune in and be with us for that. And we're going to break down everything that this report taught us about what the Fed took away and what they said and what they're going to be doing moving forward, what we get from the market. So I hope you'll be with us. Anyway, thank you guys for tuning in today, and I hope you'll be back with us next time.